and now is one of their options instructors. And just to kind of give you an idea on the schedule, we'll have Charlie Finn on, and then Charlie will be followed by Doc Severson. Doc will be followed by Fausto Puglisi, and then Fausto will be followed by Ray Stein of Ninja Trader. So Charlie, if you want, you can go ahead and get the desktop sharing going, and we'll give you guys about a minute. I know a lot of people were wanting to sign up for Steve's offer, so I'll put a timer up there while Charlie kind of gets his slide set up and going. We'll give you about a minute there. David, this is the Doc Severson, that's right.
Morgan.
If for some reason email, I can take care of it for you. Sorry, Steve, go ahead.
I'll leave the offer open all weekend for people, so they're not rushed to get in right now. They can come back during the weekend, not miss anybody else here.
All right, great, and we'll post a recap when we post a recording as well. So thanks again, Steve. Here's how you sign up, guys. I'll type that link in again. We've got a timer up. Charlie's going to come on in about 40 seconds.
While the timer is counting down, Morgan, just an audio check real fast. Hear me okay there?
All right,
and we'll wait for another 12 seconds in case someone's going out to get coffee or something. Hey, Steve, I would like to thank you very much for that. I learn something every time. So like Morgan said, I am a student, but I started trading options a long, long time ago, back in the 70s. Okay, timer's going. I think we've got a slide projection up. I'm looking at another computer, so it looks like it's up correctly. So once again, I am with DTI, Diversified Trading Institute, in Mobile, Alabama. And I live actually up in Atlanta, so I'm doing it remotely here. And of course, what's the first thing that you've always got to see? Well, let me do this first before we do anything else. I'm going to try to watch as much as I can all the chat go by. If, in fact, I miss anything, there is my email. So please feel free to send me a message and I will try to answer it. I will look as much as I can and say on the chat and hopefully I catch everything, but I'm by myself here. All righty. Of course, what's the first thing that you've got to always see? The disclaimer. And of course, everything that we're seeing here does have risk. And we're not recommending any particular stocks. However, during my presentation, you will not see an ABC stock, XYZ stock. You will see actual stocks and actual cut and paste off the screenshots and short period of time. Okay. First off, it's a little delay there. We're doing this a little different than normal. Generally, we put up the slideshow on Omnovia and download it, and it's pretty well instantaneous. So today I do have some delays, so I'm going to have to work a little bit different than I usually do. Okay, first off, when we're doing trades, you know, do you feel like this, you know, when you're trying to determine the stock price and you're kind of pinning the tail on ducky with a blindfold on? Well, can we increase that probability of pinning the tail at the correct location? And the answer to that, of course, is that we want to look at a particular stock at a certain price and see right where it's going to be and see if we can't do that. Well, how do we use options to forecast the pricing on Friday's close? Now, why Friday's close? Because that's options expiration. We have a lot of stocks now that have weekly options. We can use this a lot. Those that don't have weekly options, we can look at in February, we'll have February's options. And then some months we actually have more of those. So we'll have quarterlies. And nowadays we have Apple trading 5 weekly options so that we have not only this week, but next week, next week, next week, so we can look at it. Can't see text at the very bottom of the screen. Morgan, can you help them out on that, please? Okay, let's see what we're looking at. Now, what we're trying to do is a process commonly called pinning. And we're going to use the, oops, did I have a slide missed here? No, okay. We're trying to use the options for, okay, here we go. That's what I'm saying with the delays and all here. So we'll get back into work. Okay, so we're going to use options to forecast prices at Friday's close, and it's a process commonly used, commonly called pinning. And before we go any further into this, I'm going to give you just a very audience that we have here, trade options. One option, first off, is a contract. And we're using it to buy or sell an underlying security. And we're doing it with a certain price, and that's called the strike price, in a certain period of time, that's called the expiration time, and we receive a specific value for it, and that's the premium. And we'll show you real fast how to use these different things here. So there's two different types of options. One is a call. Now a buyer is going to pay a premium. He has the right to purchase that stock from you, and he expects that underlying stock to increase if he's buying a call. Now, with a call with the seller is going to receive a premium. He has that if that buyer calls from him, and he's going to generate income. This is the important portion that we're going to get to here now. Now, a put, a buyer pays a premium. He has the right to sell it to the seller at that specific strike price, and he's expecting the underlying to decrease. Or he wants to hedge his position. For instance, we are long Apple stock, and we want to protect ourselves so we can actually buy a put. And if it goes down below that, we can still sell it at whatever that strike price is. Now, a seller is going to receive a premium. He has that obligation to buy that stock at that strike price. And why does he do it? He's generating income. This is the other side of this. Now, how do we use options to determine that probable price on options expiration Fridays? The answer is open interest. And if we look at open interest, it's just the definition. It's the total number of options contracts that are not closed or exercised on a particular day. So it's how many that are out there. Now, what you typically see is volume. And volume goes up and down. We buy and sell and everything. But that volume, we may be buying a contract that's already open for somebody else and that's selling to somebody else. So it stays open. So we look at how many of those contracts are actually open. So let's take a look here now. Stocks have a specific number of shares, always the same number of shares that are outstanding. We can take a look at that. I mean, they can sell more and and buy them, but when you're trading, those number of shares don't change. The options always have a variable number of contracts. These transactions are identified as open or closed transactions, and typically we're going to see those as a shorthand. It's STO. We're going to sell it to open it. STC. We're selling it to close it. BTO, we're buying to open, and BTC, we're buying it to close. If you're not familiar with how open interest works, let's do a little example here. So our first transaction, user A, is going to buy to open a call, and user B is selling to open that call. So we only have one in our open interest. Our second transaction, user C now comes in, and he's going to buy to open 5 calls, and user D sells to open 5 calls. So we have a total of 6 in the open interest. Now, we can go back in. User A is going to sell his one that he bought, and he's going to close out that position that he had. And user D is buying to close out one of his 5. So now we have 5 open interests. I'm not going to go through this anymore, but you get the basic idea. You can look at this on a replay if you'd like. But it's always going to balance out when someone buys to close where someone else had sold it to open. So, okay. Now, if we sell premium, where do you expect the stock to be at expiration? Now, this is the strange part that you're looking at. The callers want it to be below the strike price. The call sellers want it to be below strike price. And the put sellers want it to be above. Why? Because they want to keep all that premium they received. So it's a schizophrenic trade here now. Hey, I want it to be above. Hey, I want it to be below. So what's going to happen? Where does that really leave us? Well, it leaves us with the money flowing into the stocks towards the strike price that has the most total open interest. Where are the most people sold premium for puts and for calls? So we add those together. Now, why does this happen? Well, it's not the retail guys that are doing it. It's the big guys. The Morgan Stanleys, the JP Morgans, they have just a tremendous amount of this stock that's in their vaults. Now, it's an investment property really to them. if you were to buy an investment property, a house that's out there, and what do you want to do with it? Well, a house, you don't want it to sit just in your vault, sit out there on that lot. So what do? You rent it out. And you continuously rent it and rent it and rent it and rent it. And you're trying to increase your income. Well, it's the same now with these guys that have a lot of shares. Even the retail seller. What's the first thing in an option class that people tell you to do? You sell covered calls. So it's an income trade. But you don't have the ability to move the stock price. Now, when we're talking about people that have, tens of thousands or millions of shares of a stock, they can effectively move the stock within a certain range. So let's take a look back last month and see how this worked. And these are some slides that I did from a different presentation. Then we're going to go and move into a recent one from this week. Okay, so on this chart, I'm and we can look up and down the slide, and we can see that. Whoops. We can see that the maximum areas here is right around that 255 area. And all I'm doing is adding the left side to the right side. The 250, 255 areas have the maximum here. Well, this was on the weekly options that expired on week 2 in Amazon. And then I look forward on to the monthly options that expired the following week. Where is the maximum open interest? Well, once again, it's the same area. And we can highlight that area. We can look down in here and we can see that 255 and 260 areas have the most open, 250, 255, 260, all that area is the highest open interest. So what can we do? We have a possible pinpoint, and what can we do with it? Well, this is the part that becomes the little art. Now, what I'm telling you that's special to me, it's information that you can look at yourself. I'm not going to try to sit there and show you trades every day. What I'm trying to do is just show you how you can simply look at this and figure out an area where you can make a trades. Now, the art part comes, how do you make the trades? And you can be fairly simple on it, or you can be real complex, and that's your choice of style. But in this case, I'm saying that it's looking like it's going to stay in that 245 or 250 area, above the 250, between 250 and 260, I'm sorry. So one of the things I can do is say, I want to sell a put spread. Now, what's a put spread? All we're doing is selling a put, and we're buying another one for protection on that, and we get a credit. And in this case, we get 67 cents credit. And what it has to do for me to make money is stay above 250. Okay, I can do that same thing on the buy side. I can sell a call spread. In this case, I'm selling one for 255, and I'm buying protection at 260. And that protection is simply saying, if it runs crazy on me, I want to have a limit. It's an insurance policy. And I'm collecting $1.03 here. So I can do either trade, or I can look at the risk on these trades. And the risk is simply the spread that we've got, the $5 minus the credit. Well, if I put the put out there, I'm risking $4.33 for that trade. If I do the call spread, I'm risking $3.97. They're generally on a 5-point spread. My own rule is that I like to have $1 or better of premium, and I look for around $1.50 if I can get that. That's a real sweet spot. So how can I increase the income and reduce the risk? So I just say, hey, let's create an iron condor. Now, I'm not trying to teach all the options classes right here. What I'm trying to do is how we can trade around a pin trade. So I wasn't exactly sure where it was going to be, but I thought it was going to be either 250 or 255. So I'm selling that put spread, 245, 250. So I'm saying I think it's going to stay above 250. I'm selling the call spread at 250. Total credit in of 150. Never reduces my risk. It's only 330. Now, Amazon, the next day, the price dropped to 251. It was right in the middle, and that iron condor premium had collapsed to only 80 cents. Guess what I did? I didn't worry about it anymore. Just go ahead, close the position, take the 90-cent profit in one day. Can we repeat this? This was a month ago. Can we see what we can do with Apple? And let's see what we can do with Google. And this was just trades that closed out yesterday. Now, I'm working with DTI, and we work as a team. And Friday a week ago, on the 11th, Tom Busby is the CEO, and he runs the early bird trades. And we start at 5 a.m. Central Time. You'll see us out today. And then he asked me to take a look at Apple and see what we think about Apple. Well, Apple was trading early in the morning. I think it was 5:24, and this was before the market opened. And we said, okay, well, if we see it move down, we'll probably go short and buying a put on it. If it moves up, we'll probably go long by buying a call on it. And those were the kind of trades. And I only had a small amount of this page open, and I couldn't see down to 500. So I opened it up a little bit more, and I said, gosh, look at all that open interest at 500 that's down there. You know what? I've never seen that amount of open interest on Apple before. We're talking about, what was it, 65,000 contracts of open interest. And I said, hey, guys, if you want to take a lotto ticket, let's think that Apple, in a week, 8 days from now, is going to close at 500. Okay. At that time, I said, let's go ahead and think of something real simple and that wouldn't cost much and take a lotto ticket. We did a butterfly. And we did a butterfly at 495, 500, 505. And I'll go through that in a minute. When Monday came, I was out in Las Vegas with DTI in a workshop that we had was going on, and we looked. Well, now that open interest has increased even more over the weekend. So it's more a stronger indicator that we've got a high probability now. Instead of just a probability, it's increasing to a high probability of being at that 500 strike. And the stock had dropped to what? 504. So we've gone from 524 Saturday morning before the market opened to 520 during the market, and now it's Monday and we're at 504. So what I put out on Friday was to go ahead and buy that butterfly, and it was 22 cents. Now, of course, in contracts of option, you can only do this in 100, so it costs $22 per contract. You could put on 10 contracts for $220 and have a fairly small lottery ticket that's in play. But now Monday's come out, and we've seen a higher probability of this trade going. So I looked at it, and during the room, I said, hey, if this thing runs up to 520, I'm going to go ahead and sell a call spread up above 520, 525. Well, then it started to run back down, and I said, okay, if it runs down to 480, we'll sell a put spread. And the ultimate trade would have been, if it ran up to 520, sell it up there. If it ran down to 480, and then it ran down to 480, I could sell more down there, and we could have, just huge premiums and all in these because we're fairly certain that it's going to close at 500. Well, it didn't do that. It stayed in a smaller range and all. So I ended up selling an iron condor, and I only got $2.34 on it. What I was looking for, I was hoping to see it run up to 520, and I could sell a spread up there for $2, $2.50, and then run down 480, and I could sell another one for $2, $2.50. Didn't work that way, so I was happy with what we got. We got 234. Now, how does this make some profit? If the stock closes anywhere between 490 and 510 now, I'm going to keep that 234 premium from the iron condor. Now, profits on a butterfly, it's got to be within that 495.22. Remember, I paid 22 cents for it, and 504.88. But it's not very much of it's out on those edges. Those are the break-even points. Where the sweet spot is if it closes at 500 at expiration, and this butterfly would blossom out and be worth $5. Now, I'm not worried about trying to capture $5. From 22 cents, what I was looking at was $4, and that's only a 1,600% profit. Now, this is nothing magic. I'm not doing anything magic. It's something that everyone can look at and just say, hey, the open interest is there. We've got a high probability of this trade going there, and it's become now, on Monday afternoon, a trade that you see once every 6 months or a year. So I loaded up more and more on these things. And what happened with Apple yesterday? And I will tell you the way I traded it, and please, I mean, you can be real simple and just stay with that 22-cent trade, but I was constantly building the position around this. I was selling some more spreads up above. I bought some more below. I put another butterfly on when it was down at 490 something. I put on a 45, 490, 500 butterfly. So it's all kinds of complex stuff that you can do. But don't worry about that. Take the simple portion and then learn how you can move these things around. So Apple closed exactly 500.00. Now, I have never had one, well, I have had before, but it's very seldom that you have it close exactly that. What I had told them Friday morning in the trade room about 5 a.m. was that I expected Apple to close 500 plus or minus 25 cents. So we did that one good. Closed out the Iron Condor for 10 cents. Now, why did I do that? I bought back both the put and the call short sides, so it reduced the risk. So if something came out and all of a sudden Apple's plants in China were attacked and it went down, I don't have the liability for that. So I'm locked into my profit. So I automatically, as soon as I put on a spread, as soon as I put on a Iron Condor, I put in orders to close them at 5 cents. So that was what that was about. Now, the butterfly, I had an order in for $4. And I told most of the people, I expected to sometime around 1 p.m. to start to increase quite a bit. It took a little longer. We did close it out for $4. Some of the guys got $4.24, I think it was, or $4.24 or $4.44. I can't remember which was the highest. But I paid 22 cents for it, so I only made $3.78 out of it for a total profit of $6.02 on this. This is not magic, guys. Don't look at me to do this stuff for you. What I'm trying to teach you is how you can see this and do it yourself. Well, let's look at the trade for Google. We still have plenty of time here. And Google, this was on the 16th. This is last Wednesday. And this is when you typically see pin trades. Generally, pin trades do not show up year, or at least the 6-month period, or if not the year. This is more likely what you'll see. So on the left side, we have the open interest on calls. On the right side, we have the open interest on puts. And I'm looking here, and I reach up and I'm seeing, hey, the highest open interest is at 700. Now, the stock is trading at 715 now. Okay. If I'm wrong, I don't want to risk a lot, so what's the first thing I can do? I can just put on a small position, and once again, I can just do a butterfly with this. And the butterfly, when it's that far out of the money, was fairly inexpensive. It was 34 cents. So I put in a small position with a very small risk. What's my risk? 34 cents. So it's a defined risk trade now. 34 cents is the maximum that I can risk. So now, what next happened? Google dropped reinforcement that it's going down to my 700 area. So what do I do next? It's got a high probability of trading at 700. But what if it stops at 705 or at 710? I want to make some money out of this. Now, Google and Apple tend to pin at the 10s. It's unusual for you to see that at like 505 or 515 or 705, 715. It's just a way that it tends to work. And I think that is because people tend to buy protection on the 10s, and they also, when they're doing their long shots, they tend to buy those on that. I think that's what it is. I can't tell you, but all I can tell you is that I've seen that type. And this is definitely a directional butterfly. I am looking for it to move to, it's out of the money. It's totally out of the money. I'm looking at 695, 700, 705. And we're trading 711, 715, So it's a long shot right then when I first put it on. But now it's starting to sit there and say, hey, I'm going to do what you wanted to do. So once again, I think it's going to go to 700. but it could stop at 705, and it could have a higher percentage of stop at 710. So I'm going to say sell a 710, 715 call spread, and I took in a premium of 237. So now, where is my sweet spot? Anywhere's below 710, I'm making a lot of money. Actually, I can make money anywhere's below 712. Why 712? Well, I paid 30 some cents for my butterfly, so it has to go out of here. So I actually have a premium, total premium that I'm receiving of $2. So as long as it's below 712, I'm going to make money. As long as it's below 712. Now, if it goes below 710, I'm making my maximum amount for my call spread. But I use this call spread to also finance buying some more. Anybody guess? 695, 700, 705, put butterfly. And I was buying those now at 40 cents. See, the butterfly hasn't moved up much, even though the stock has moved down about 4 points. The reason for that, it's still out of the money. All right. So what actually happened Friday? Remember, I put these on Wednesday and Thursday. I bought the initial butterflies Wednesday, and then we sat there and sold the premium on Thursday and bought some more butterflies. Okay, the stock dropped down to 701.50 in the afternoon. The automatic close that I had for 5 cents triggered off, so I had $2.32 profit out of that spread that did. Closed out the butterflies. Now, the lowest I got was 170 on this. It went up to 220. Some of the folks took that, so we got $1.36 on this. So it gave us a total profit of 368. Now, this is a basic trade, and I put out throughout the day, we sold additional premium, just let you know how you can manage the trade. It has nothing to do with it. You know, what I'm looking at here is a fairly simple trade, but how you can manage it and make more. Well, as things were working along, I put out to sell additional premium for that 710, 715 call spread when it was right around, it was right around 710, I think, somewhere in there. But we sold some more at 210. And then yesterday morning, the stock was around 706, 707, so it was below my 710. So we called and actually sold more premium on that spread at 115. So we've got premium spread 237, 210, and 115. The stock did not pin at 700. It went up to 704.50, I think it was on there. So at the end, if you had held this butterfly to the end, you would have still had a 50-cent premium on the butterfly, so you could still make some money on it. But we took the profits before that. Why? Because this wasn't as strong of an indicated trade as Apple was. Apple was extremely strong, and it looked like it was going to have nothing but closing at 500 plus or minus that you know, a little bit. But Google could have stayed up, so that's why I started to take profits off and started to tell people at 170, hey, you might want to consider taking some of the profits off. And it was spread all around. But we had all this other profit that we got from the spread sells and all in here. Let me take a look at a couple of the chats here, because I'm sure I missed them. Please bear with me while I look back here just a little bit. Butterfly is the same as an iron condor, but the short strikes are equal. Not exactly. An iron condor, you would sell it would be a combination of a put spread and a call spread. On an iron condor, we're going to do all puts or all calls. Now, why would we use one versus the other? And this is kind of, you know, I'll go in, it's outside of the scope of the pinning, but let's say Google right now, I thought it was going to go to 700, but it was still a possibility, a strong possibility really, that it would stay above 700. So it would stay above the 705. So if it's above 705, if I use puts on that, all three sides of that are out of the money and they can expire worthless, and I don't have to buy it back to remove any risk. So it's just a way that I can sit there. If I'm wrong, I don't have to pay more for commissions and all to close out a position just to remove risk. Now, if I did the call side, the actual cost and the profits that I make would be exactly the same. But if it stayed up above 705, I would have to close out all three of those positions. Well, that was strange. I don't know why the screen blanked there. So I'd have to close out all three of those positions, and I would have to pay my commissions. All three of those positions, and I'd have to pay commissions on. So that's why it, like I say, it doesn't matter which you put on as far as cost goes. I can look at a call butterfly. I can look at a put butterfly, and there's only going to be 1 or 2 cents difference between the two. And if it's in the money, I'm only going to have 1 or 2 cents difference in the profit that I take out of it. And okay, let's see. Yeah, I mean, if Apple goes below 486, yeah, I'd be in trouble. And same with Google. That's just a directional trade. We're not going to worry about that too much. Tim, where can I learn more about iron butterflies? I'll tell you what, that's one of the things that we teach on in the classes and everything that at DTI. Does this work anytime or only at expiration? An iron butterfly only works at expiration. The return sets there. Well, let me see. I can give you an example where Apple pinned exactly at 500. It took the whole day. At the beginning of the day, the butterfly was worth $1. So from 22 cents to $1, is that money? Yes. But I wasn't in it for $1. I was looking for the $4. And then probably 2 hours into the trading day, it went to $1.70 or so and stayed around there. And as it got closer, it was only the last, I would say, probably 35 or 40 minutes that we saw it get up near the $3.50 to $4. So it takes getting very, very close to the expiration and all for it to do that. Can you do this with weekly options? The answer is yes, you can do it with weekly options. The fact is, though, that you don't have as much time in there, and the open interest doesn't show quite as good. So what I do with weekly options is then look at the monthly options and try to overlay the two, and if they both are looking the same, then the probability increases quite a bit. Now, Apple now has 5 weeks worth of options, so that it has a lot longer time. So if we only have that one weekly option, you only have a maximum of 8 days that can do it. But now, this 5th week here, actually it's the same as a monthly option if you look at it. So there's been a lot more time for open interest to increase and all on that. So those will work, and they do work well. The strategy on this, to give you an idea, what's the percentage of winners for the strategy? I started doing this at DTI for a weekly options room that we started in July. We ended up with Apple week after week after week after week. We did that for, I think it was probably 3 months, and we lost 1 out of 9 or something like that with it. It was that good. Apple then went completely bats, and we hadn't done 1 since then until just this last week. The week before, I said, was the first week that it was looking like it was becoming more normal. This week, it was just no way that I could not put a trade on for this week. And yeah, it was an extraordinary trade, there's no question. But Google didn't pin at 700. But what happened? How did I make money on Google not pinning at 700? I said Google most likely was going to go down close to 700, and it was going to go down in there. And I used the additional strategy by selling the premiums and the spreads to make money, even if it didn't pin right at my stock. So that's the way to use it and all. Okay, go back down here. Do I use toss? Actually, I do myself. Yes. Okay. And that is correct. The reason that I buy them back at 5 cents is there's no commissions. Several brokers do that. Why do they do that? Simply because they say, hey, your money's freed up and you'll probably make more trades. And they also reduces the risk. Okay, what are the consequences of Apple's pin on Friday? it's completely gone now. It doesn't say a thing to us because that period of time is over with. And now we would look at next week's or the week after's pin. And on Apple myself, right now it's too many externals that are going on. Will I do an Apple pin next week? The answer to that is no. Why? Earnings. It could go everywhere, and I will not do a pin trade on an earnings trade. Now, will I make a trade for it? That's something totally different, and that would be an earnings trade, and we might look at that. But I would not try to do a pin trade on it. Okay, I'm all confused. I hear all that you were saying, but don't understand the basic setup or how to do it. There we go. What I'm trying to do is an introduction, and it is an education, and I'm trying to introduce you to things that you can do. So basically all we're looking at, let's go back on this because I do have enough time here to do this. All we're trying to do is look as it gets near expiration of an options, we're going to look at where the total, the maximum total, open put interest and call interest lies. Much larger area than any of the other areas, then we'll tend to move to that. Now, if Apple were, say, at 550, and I saw this huge amount at 500, and I saw a large amount at 520, and a large amount at 530, I'm not going to try to say it's going to go all the way down to 500. So even though it was the largest, the probability is very low that it's going to get there. So it's where the strike prices, the highest strike price open interest, total open interest, is the closest to where the stock is selling that you probably would want to look for. Okay, given the risk reward would have been worth Butterfly and Apple at 495.5. That's what I did. The Butterfly was exactly 495, 500, 505. And then I put another one down when it came down at 485, 490, 505. And we continued adding those 500 Butterflies. We continued adding a lot of those. Okay. Where do I see Apple going from here?
Hey, Charlie?
It's outside the scope of this, but yes. Go ahead.
Hey, Charlie, can you try stopping your projection and starting it again? I think your screen froze.
I will do that. Oh, I wasn't trying to do anything else. I was just talking on here, so I didn't move
Okay.
it. There we go.
Okay, there we go.
Okay. Because this was the end of the presentation, and I wanted to go back and the basic part of the presentation. Okay. Guys, I have just a ton of questions in here, and some of these I won't be able to answer, I'm sure. So once again, if you send me an email, and I'll put it down here again, I'll be glad to try to answer those. A couple more here. If I made 1,600%, I'm not worried about the commissions. The commissions are exactly the same there. But the fact was that what I was worried about was that it would not go down to it. That's why I didn't want to have to pay commissions if I didn't need to. Okay. So anyway, let me just tell you, first off, on this, once again, I am running what we've called a weekly options room for DTI and mentoring that. It's really a misnomer. It's a short-term or tactical options, a couple of days to a couple of weeks to possibly a month. Now, we do some intraday trades and all, and we're looking, those are mostly directional trades doing that. But if you're interested in that, contact DTI, send me an email, we'll do that. Now, one of the things that's a real problem, I had a lot of people on Apple on the pins, and they're saying, oh, it's $1 now. Is it $1? Let's take our profits. And the probability was that we were going to get much, much higher. The probability was that we were going to get 4. Were we going to get 5? No, I wasn't even trying to shoot for that. But I was saying that 4 is a fairly high probability trade. And to try to stay in the trade, you have a lot of mental anguish that's going on. And one of the things, it's an emotional control. And Sunday night, Tom Busby, the CEO of DTI, and he's been a trader for over 30 years, is talking about emotional control. And we have a link here for you, and if you want to click on that link, and Morgan, could you put that into just the announcement so that if it doesn't work, they get that or in the chat. But he is going to do that. If you click on this link, once you've clicked on it and filled out the little bit of information there, you're going to receive an email and being invited to the Sunday evening presentation on it. In addition, and all of us work together on different things. And Tom has been working on a trade, and we're going to go on a safari, and we're going to hunt big game. It's going to be an elephant. We're thinking that the market is going to actually turn around for some time. And Tom has put together a trade that will be using futures and all. And he's using stops and everything like that. But I'm basically changing that trade around, and we're going to be doing that this Thursday. And we're going to be hunting elephants using options as protection and see if we can't stay in the trade longer without having to take the possibility of being stopped out and having. Do I have a Twitter account? You know what? I don't. Don't do that at all. Within the options room, the way that we do that, we use Yahoo Instant Messaging and emails, and then we're using the Omnovia like you have here. So we put out the trades and all, instant message out to folks. They get it emailed, and they'll be able to get it. But DTI use toss and training. It depends upon the particular instructor. We use a lot of different platforms, and we do not try to be platform specific. It's just that I've been using it for years, and it's options platform. I've learned it so well, that's all. Boy, this stuff is sliding across the screen so fast that I can't read it. Rob, great, Rob. My room is basically open 24 hours. It stays open all the time. However, options on equities is only traded during the normal market hours from 8:30 Central to 3 Central. For most, there are some others that are, but you can get the trades, like say, are IM'd and emailed right away, so that you can put those trades and all on. Even if you're in another country. We have a lot of people that do that. There's no question about that.
Great. Well,
okay.
Thanks, Charlie. We appreciate appreciate you being here for sure. Absolutely. Excellent job to Charlie Finn, and it's kind of cool. Charlie actually was a DTI student who's now their options instructor, so he can definitely share with you from the background of both a student and instructor, and we appreciate him taking the time to be here today. I'll post the link again. Basically, what Charlie offered is that there's a special session Sunday night, so tomorrow evening, with DTI. It's on the emotions of trading, and one of the things that you'll see on that link, it's basically a survey, and the reason that survey's there are lots of questions to answer. Not a lot, 6 or 7, but basically from the time they started doing those surveys, the majority of issues that traders have had and is really a lot on the emotional side of fear and greed, and so they're doing a special, basically it's kind of a webinar scheduled in response to a lot of the surveys that they've received. So you guys can fill that out and hit submit, and you get access to that free session on Sunday evening. I think it will be a very good session indeed. So thanks again, Charlie. We really appreciate you being here and taking the time to be with us. So I will, Don, the special offer Charlie's made, we asked each person to make some kind of offer. The offer Charlie's made involves the Sunday night session, and so you can gain access to that. And I tell you what we'll do is I'll get with Charlie, and anybody that signs up for that Sunday night session, I'll ask him to come up with some kind of really big discount to get you guys some time in the option room as well. How does that sound? So I'll get with Charlie and tell him to get everybody who signs up for that Sunday session at the link, because they'll know that it came from from you guys hearing him at the Trading Club, and I'll get him to come up with a really really good discount that he can email out to you on Monday. All right, so again, if you want that, you can just sign up at that link, put your info in, and kind of let them know your thoughts on the market, on trading, and things that you'd like to learn, because that's how they really gear their webinars. All right, very cool. Thanks again, Charlie, and happy birthday. I know your wife had a birthday yesterday, so happy birthday to you, or to her, actually. And at this time, I'm going to turn things over to our next speaker. Next speaker is Doc Severson. And again, I actually came across Doc, I guess probably about a year ago, and have had access to some of his videos and his training, and he really does an outstanding job. And so we're thankful to have him here. And Doc, if you can do a quick audio test, and then you can go ahead and take it away. And I tell you what, we'll put about a minute and a half timer up there while Doc gets his screen set up, and then he can kind of take it away, give you some time to fill out that survey that Charlie had posted. Yeah, here's the link one more time.